as always. And then can't help but talk about what's happening within the IT pack first, because, if you juxtapose to what's happening globally and that, mean reversion of selling software, buying chips is actually taking place. Do you sense this move on IT software is going to be long-lived at all, or do you sense that it's just a tactical bet as of now?
Thank you, Aisha, for having me on your show, and a very good morning to you, your team, and the viewers. I was expecting this. I was expecting you to start off with IT, given our position on IT as such. So here's the thing. I mean, first of all, there's no FOMO from our side, because our top two holdings, the top holding is Eternal, and the fifth largest for us is Paytm. They're, I think, equally up as compared to the IT majors who've seen a lot of drop and then a rally. So month to date, we are not losing out. As I said, there's enough in the markets to take care of that. Secondly, the fact that AI is getting hit because of the kind of expenses that these are spending on compute capacities and stuff like that. I think that's no reason for the IT services guys to react positively. So I don't see, in fact, I was just looking at the FI flows, and I didn't see any flows coming into the IT segment per se. Whatever little that we could gauge was more of a short covering trade, which was happening as such. Obviously, everybody was pretty short, and it was very obvious when Infosys came out with those bad numbers and the fact that they cut down a very small, anywhere low guidance, also they cut down to another lower guidance. It was obvious that, and the stock didn't react, by the way, it went up after that. So it was obvious that there was a lot of fatigue in the market in selling those names, IT services names. And that's why they held on to that. So I don't see that panning out for a longer term. I think the trade will reverse at some point in time. Frankly, I mean, as long as the growth rates are low, there's no hope for us to even look at those sectors. I mean, they're talking about 1 or 2% kind of top line growth. How much can they improve the margins to give you an exciting bottom line growth? So that's not going to happen. And that's why we are staying out of this whole rally as such. And we again believe it's a value trap which is being created for gullible investors.
Dinshaw, one mixed bag has been consumption. You've seen a disparity there. Very strong numbers, say, by Nestle. HUL was a little bit disappointing versus, of course, what they were guiding for. You're also seeing that impact on Dabur. How should one play consumption at this point? Would you play to some of those names? I know that platform companies are a favorite for you in terms of playing consumption, but how are you looking at the trends?
So here's the thing about FMCG. Frankly, I mean, we are very clear that that segment per se is very saturated in the consumption space. As I keep saying that, just because I'm earning more doesn't mean that I'll be brushing my teeth 4 or 5 times a day or taking a bath 5 or 6 times a day, right? So that's not going to help in higher capital incomes. Maybe premiumization will take place, but beyond that, there's not much of growth that can be expected out here. So any positive number is taken fairly positively. Like, for instance, in the case of Nestle, Lever, I think, was again, there was a fatigue in the short covering trade, which happened, I suppose. So that's why the things turned around for that. But really, I mean, in the FMCG space, we're not too excited. We'll pay consumption through, obviously, as you rightly mentioned, the new age companies, and also through discretionary. I mean, I think that's where the real fun will be once these per capita start moving up. That's where the real growth will happen. So that's why we'll be sticking to those kind of plays rather than pure FMCG and staples.
Beyond Eternal, then, Dinshaw, where is it that you've expanded the consumption pool to?
So, no, Aisha, we've not gone ahead and added anything to the consumption pool as such. But however, what we've been doing is we've been adding to these names as in when we see some corrections happening as such. And that's what we've been doing. There's no new name that we've been adding to. You will see the portfolio for July, as when it comes out. You'll see that there's hardly any new names that we added in that space per se. So I'll leave it here.
Any new names added in the banking space, Dinshaw, or you stick with the old ones?
No. We're sticking to the old ones. Banking seems a space which has done its bit. I mean, as in, not done too much, anyways. But the fact is that we are very kicked about the mid and small cap space. So, in banks, most of the big ones are obviously the large caps here. And even the results were not that exciting. So, we've not added to that space because of the flows. You'll see the weights have gone down. But it's not effectively we've sold anything as such. But we've not been adding to that space. Frankly, I mean, we believe there's much more excitement in the financial services space in the mid and small cap range rather than in the large cap space.
Which is why I'm surprised, Dinshaw, that you're still holding on to HDFC Bank. I know a lot of the investment holdings are a function of what price you've paid to buy the stock, but still HDFC Bank, what gives you conviction?
No, so Aisha, one thing you must appreciate that it was probably a top holding a couple of quarters back, and today it's not even the top five. So that's what gives us that comfort that we did chop the name a bit, but frankly, I mean, if you're bullish on India, you better be bullish on the large cap banks per se, and that's why we're holding on to these names per se. ICICI has done very well. Even the results were fairly good. But I think apart from these two banks, we don't have much exposure in the banking space. So we're hanging on to these two. And as I said, that I think the bigger excitement will come in the mid and small cap range. In fact, the reported numbers thus far also point to that. Till day before yesterday, we were just checking up the large caps numbers that came out. There's earnings growth of only some 8% odd. For the mid cap space, the same number is 36%. And for the small cap, it's 60%. I'm sure bulk of the bad companies will report later. But frankly, I mean, coming off from that base of 60, because most of the large small caps have reported numbers. And that's why we are very comfortable that the earnings growth, which has been fairly high in mid and small caps, will continue even in this quarter, which you saw in the March quarter. You've seen that in the December quarter and even the September quarter. So we are fairly comfortable out here.
What else is it that you're adding then, Dinshaw? Because some of the trends we've spoken about, you're actually either holding or maybe even trimming or a little bit cautious. So what is it that you're seeing new in the market last 2 to 3 months? What is it that you're liking?
There's nothing new, actually, Harsh, which has happened in the market as such. And that's why we are very clear that we added a few names. I mean, you've seen in the June portfolio that we added a few names in the space of consumption, because that's where we believe the real growth will come through. And that's why we've been nibbling at those places or at those spaces as such. In terms of discovery, again, in the same segments we've been discovering, you'll see in the July portfolio. I will not mention names because, frankly, I mean, it's going to be declared. It's not non-public information. So once it's out, you'll see the few names that we added in July portfolio. Again, this is mainly in the small and mid-cap space that we've added the names. Even in the financial space, we added a few names here. So that's why I think you keep getting ideas. And frankly, I mean, these trend changes don't happen overnight. They take a while for things to turn out. I think one area that we've now started looking at is the PLI space, because with the fresh scheme coming out, there are quite a few, not quite a few, but a handful of players who are going to benefit out of that. So we've been looking at those players also. You'll see the additions there also as you see our portfolio for July. So I'll leave it there. I won't talk much because my compliance guy is always very unhappy with me when I'm on TV.
Okay. But Dinshaw, other than that, the market has also been spotting trends within the entire AI theme. Now, of course, India is not the country of those large LLMs or, product prototypes. But the layer 3 and the layer 4s is where one is scouting opportunity. Anything that you're liking within that pool?
So, Aisha, frankly, I mean, the only AI exposure that we've gone ahead and done, I mean, not we as in Helios, but India, I think the only claim is that we're going to set up data centers for the compute spaces. And that really is not exciting at all because you're talking about basically a leasing model. You're talking about a rental model in place. That doesn't excite us too much. It's a real estate play where you're now starting to look at yields per se. And frankly, I mean, the world doesn't want data centers in their backyard. I mean, there's a there's a movement in US called NIMBYs, not in my backyard. They want to use data centers, but they don't want them in their backyard. So we are doing that out here because, frankly, I mean, why they don't want it? Because they're very heavy on power consumption, very heavy on water consumption and stuff like that. So that's why I think it's not a model that will excite us going forward. Frankly, I mean, we haven't seen anything beyond that. There are smaller players which are there in the equipment supply space and all that we've looked at, and we've not got too excited with those also.
Dinshaw, two things that have stood out for me in this earnings season. One is that banks coming out and saying that corporate lending has picked up, and there's competition there as well. And second is that L&T coming out and saying that private sector growth from a cap goods standpoint has really picked up in terms of the order book. How do you play themes like this? Because these, firstly, your sense, is this going to be like a 1 year, 2 year, or is it going to be a slightly longer theme? How do you play it?
No, actually, you mentioned that, Harsh, because private sector capex has been picking up. In fact, FY25 was the first year when you saw 20s kind of growth rate in the private sector capex, and 26, I'm talking fiscal 26. In fact, this quarter again, whatever commentary we've heard, it's fairly exciting on the private, and then L&T further corroborated the same, that they're seeing a lot of private sector capex kicking in. I think that's a very big positive news for India per se, because we need that employment. And by the way, private sector capex leads to a lot of employment as compared to public capex. I mean, the government capex as such, because that's mostly infra, and this is mostly productive assets which kick in. In that space, what we've done is we've did look at certain, I would say, the civil suppliers and stuff like that. So, but frankly, I mean, again, we were not too excited because the valuations were through the roof. And frankly, I mean, they're looking at the capacity, the growth rate weren't looking that exciting either. So that's why we've held back on that space. We have some exposure in that space again through our other companies, which are mainly into power, because I think power is one big segment which will be needed to fuel this kind of a capex per se. I mean, as in wherever the capex kicks in. So that's why we've got exposure to that rather than anything else specifically related to that per se.
Okay, Dinshaw, just on the India manufacturing piece, right? So one way to play it is probably EMS. Anything else in terms of options of how you're playing the manufacturing space in India?
No, really. I mean, you mentioned it. I mean, we have a few names in the EMS space, and that's where I think the PLIs look very exciting also. By the way, so that is where we are more comfortable with. In again manufacturing, we have exposures to various other players who are textile. Basically, I'm talking about exporters that we are very comfortable with. By the way, Indian currency has, rather the Chinese yuan, India has far more depreciated against the Chinese yuan. So even the ancillaries, which earlier used to come, the auto ancillaries, which were competing with the Chinese players, are looking very good. In fact, even the space of outsourcing and diversification of outsourcing, basically all these ancillaries are very specific players as such, and they're also into aviation and all. So I think those are the areas that are looking fairly good for India today. And I think we got a long way to go looking at the way China is right now. I think this will play out quite a bit for us. So that's another exposure that we've taken in manufacturing per se.
So Dinshaw, where do you think the next trigger for the market up move, if at all, will really come in from now that we're at the fag end of the earnings already?
Unfortunately, Aisha, the fact is that the large caps are not doing much. Again, as I said, that the headline numbers, which will come from the large cap index, are not looking that exciting at all. Because frankly, I mean, the biggest cohort in the large cap today are what? I mean, banks, which are not doing too well. Rather, they're facing a lot of they're doing well, but they're facing a lot of competition. And that's why the NIMs are not progressing as they were expected to. Autos, again, the four-wheeler autos not doing too greatly. IT space, commodities, and all these are, you know, the heavyweights in the large cap index, and they're not doing too well. And unfortunately, that's bad news for us because the passive flows which normally track, the basically ETFs, which normally track the indices, which are large cap heavy, will not fructify because we're not hurting them enough by outperforming as such. Hurting in the sense they're staying out of India is not hurting them in terms of their performance per se. But the good news is that for the last 2 months, June, July, India to an extent has started outperforming slightly a bit more as compared to the other markets per se. Not too much or outperformance, but the fact is that when Korea and Taiwan are down 20 and 10 odd percent, you tend to outperform those markets per se by leaps and bounds. I think if that sustains, maybe you'll see flows coming in. But as I said, large cap indices, I don't think are the ones which will trigger this. Mid and small is the area to be in. And frankly, again, there are a lot of exciting names in the mid and small. And that's why the growth is coming from there. They were the ones who suffered the most at the time of slowdown. And I think on the pickup, again, they'll be the ones who will perform the best.
Interesting. Well, in any case, the story has always been outside index, and that's only gotten exaggerated in the last 2 years. But Dinshaw, always good speaking with you. Thank you for your time.